Hello everyone. In this audio, we are going to study CA Foundation course, Paper 4, Part 1, Business Economics. Chapter 1, Nature and Scope of Business Economics. Unit 1, Introduction. 1O, Introduction. 100, What is economics about? The term economics owes its origin to the Greek word oikonomia, which means household. Till 19th century, economics was known as political economy. The book name An Inquiry into the Nature and Causes of Wealth of Nations, 1776, usually abbreviated as The Wealth of Nations by Adam Smith, is considered as first modern work of economics. Before we start the meaning of business economics, it is important for us to understand what economics is about. For this, consider the following situation. It is your birthday and your mother gives you ₹1,000 as birthday gift. You are free to spend the money as you like. What will you do? You have many options before you, such as option 1. You can give a party to your friends and spend the whole money on them. Option 2. You can buy yourself a dress of ₹1,000. Option 3. You can go for a movie and eat in a restaurant of your choice. Option 4. You can buy yourself a book and save the rest of the money. What do you notice? You have many options before you. Given a choice, you would like to spend not only on your friends, but also you would like to go for a movie, eat in a restaurant, buy a dress and a book, and save some money. However, you cannot have all of them at the same time. Why? Because you only have ₹1,000 with you. Had your mother given you ₹2,000, you might have satisfied more of your desires, but she has not. Now, you find yourself in a dilemma as to which of the above options to choose. You will have to go for one option or a combination of one or more options. What do? You evaluate the various alternatives and choose the one that gives you the greatest satisfaction. Similar dilemma is faced by every individual, every society, and every country in this world. Life is like that. Since we cannot have everything we want with the resources we have, we are forever forced to make choices. Therefore, we choose to satisfy only some of our wants, leaving many other wants unsatisfied. These two fundamental facts that first, human wants have been unlimited, and second, the means to satisfy these unlimited wants are relatively scarce from the subject matter of economics. Let us now examine what economics study about. Economics is the study of processes by which the relatively scarce resources are allocated to satisfy the competing unlimited wants of human beings in a society. Of course, the available resources will be efficiently used when they are allocated to their highest value uses. Economics is, thus, the study of how we work together to transform the scarce resources into goods and services to satisfy the most pressing of our infinite wants and how we distribute these goods and services among ourselves. This definition of economics, with a narrow focus on using the relatively scarce resources to satisfy human wants, is the domain of modern neoclassical microeconomic analysis. Despite being correct, it is incomplete as it brings to our mind the picture of a society with fixed resources, skills, and productive capacity. Deciding on what specific kinds of goods and services it ought to produce with the given resources and how they ought to be distributed among the members of the society. However, two of the most important concerns of modern economics are not fully covered by this concept. On the one hand, we find that productive capacity of modern economics has grown tremendously. Population and labor force have increased. New sources of raw material have been discovered, and New and better plant and equipment have been made available on farms and in factories and mines. Not only has quantity of available products resources increased, the quality has improved substantially. Better education and newly acquired skills have raised the productivity of labor force and has led to discovery of completely new kinds of natural resources such as shale gas and new alternative resources of energy. On the other hand, we know that the resulting growth in production and income has not been smooth. There have been periods in which output not only failed to grow but also declined sharply. During such periods, factories, workers, and other productive resources have remained idle due to insufficient demand. Economics, therefore, concerns itself not just with crucial concern of how a nation allocates its scarce productive resources to various uses, it also deals with processes by which the productive capacity of these resources is increased and with the factors which in the past have led to sharp fluctuations in the rate of utilization of these resources. In day to day events, we come across several economic issues such as changes in price of individual commodity as well as in general price level, economic prosperity, and high standard of living of some countries despite general poverty and poor standards of living in others, and some firms making extraordinary profits while others close down, etc. These are fundamental matters concerned with economic analysis. The study of economics will enable us to study an analytical approach that develops us in understanding and analyzing a wide range of economic issues. It would also provide us with a number of models and frameworks that can be applied in different situations. The tools of economics assist in choosing the best course of action from among the different alternative courses of action available to the decision maker. However, it is necessary to remember that most economic problems are of complex nature and are affected by several forces, some of which are rooted in economics and other in political setup, social norms, etc. The study of economics cannot ensure that all problems will be appropriately tackled, but without doubt, it would enable a student to examine a problem in its right perspective and would help him in discovering suitable measures to deal with the same. 1.0.1 Meaning of Business Economics. Having understood the meaning of economics, let us now understand what business economics is. For this, consider the following situation. Mr. G. Ramamurthy, the CEO of World Wild Food Limited, on completion of his presentation, turned to his board of directors and raised the question. Well, ladies and gentlemen, what do you say? Shall we go into soft drink business? Give us some time, sir, remarked Swaminathan. You are asking us to approve a major decision which will have long term impact on the direction of the company. I understand your concern for the company, but now time has come for us to expand our business. Soft drinks market is growing fast and is closely related to our core business, food, answered Ramamurthy. But competition from White Soft Drinks Limited and Black Nectar Limited is tough. They already into this business for years, remarked another board member. That is right. But we must not forget that statistics show there is still room for growth in this market. And also, food business is near maturity, replied Ramamurthy. Don't forget that even Swati Foods tried entering the soft drink markets and failed miserably, remarked Ashoka Agarwal, another board member. Moreover, the projections you are showing are based on last 10 years data. what is the guarantee that the trend will continue? He cautioned. Also, we should not forget that Indians have become health conscious, and who knows tomorrow what will people prefer? He continued. Well, friends, all your concerns are logical, and believe me, I've given much thoughts to these ifs and buts. My people have spent many days analyzing all available data to arrive at a judgment. Our analysis indicates a strong possibility of earning above average return on investment in this market, a return that will be more than what we are earning in food industry. We are already working on details of production, cost, pricing, distribution, financing, etc. I fear if we wait for long, we will be missing an opportunity that may not come again for long. Let us go ahead and make the most of it, remarked Ramamurthy. What do you notice in the hypothetical exam given above? The management of a company is faced with the problem of decision making. As we are aware, the survival and success of a business depends on sound decisions. Decision making refers to the process of selecting an appropriate alternative that will provide the most efficient means of attaining a desired end from two or more alternative courses of action. Decision making involves evaluation of feasible alternatives, rational judgment on the basis of information, and choice of a particular alternative which the decision maker finds as most suitable. As explained above, the question of choice arises because of productive resources such as land, labor, capital, and management are limited and can be employed in alternative uses. Therefore, more efficient alternatives must be chosen and less efficient alternatives must be rejected. The management of a business unit generally needs to make a tactical and operational decisions. A few examples of issues requiring decision making in the context of businesses are illustrated below. Should a firm be in this business? Should the firm launch a product given the highly competitive market environment? If the firm decide on launching the product, which available technique of production should be used? From where should the market produce the necessary inputs and at what price so as to have competitive edge in the market? Should the firm make the components or buy them from other firms? How much should be the optimum output and at what prices should the firm sell? How will the product be placed in the market? Which consumer segment should we focus on and how to improve the consumer experience? Which marketing strategy should be chosen? How much should be the marketing budget? How to combat the risk and uncertainty involved? Decision making on the above as well as similar issues is not simple and straightforward as economic environment in which the firm functions is highly complex and dynamic. The problem gets aggravated because most of the time decisions are taken under conditions of imperfect knowledge and uncertainty. Decision making, therefore, requires that the management to be equipped with proper methodology and appropriate analytical tools and techniques. Business economics meets the needs of management by approving a large corpus of theory and techniques. Briefly put, business economics integrates economic theory with business practice. Business economics, also referred to as managerial economics, generally refers to integration of economic theory with business practice. While the theories of economics provide the tools which explains various concepts such as demand, supply, cost, price, competition, etc. Business economics apply these tools in the process of business decision making. Thus, business economics compromises on that part of economic knowledge, logic, theory, and analytical tools that are used for rational decision making for business. In brief, it is applied economics that fills the gap between economic theory and business practice. Business economics has close connection with economic theory, micro as well as macro. Operation research, statistics, mathematics, and the theory of decision making. A professional business economics has to integrate the concept of methods from all these disciplines in order to understand and analyze practical managerial problems. Business economics is not only valuable to business decision makers but also useful for managers of not for profit organizations. 1.1 Definitions of Business Economics. Business economics may be defined as the use of economic analysis to make business decisions involving the best use of organizations' scarce resources. Joel Dean defined business economics in terms of use of economic analysis in formulation of business policies. Business economics is essentially a component of applied economics as it includes application of selected quantitative techniques such as linear programming, regression analysis, capital budgeting, break-even analysis, and cost analysis. Our approach in this context is to focus on heart of business economics, i.e., the microeconomic theory of behavior of consumers and firms in competitive markets. This theory provides managers with a basic framework for making key business decisions about the allocation of firms' scarce resources. 1.2 Nature of Business Economics. Economics has been broadly divided into two major parts, that is, microeconomics and macroeconomics. Before explaining the nature of business economics, it is pertinent to understand the distinction between two. Subject matter of economics, microeconomics, macroeconomics. Microeconomics is basically the study of behavior of different individuals and organizations within an economic system. In other words, microeconomics examines how the individual units, consumers or firms make decisions as to how to efficiently allocate the scarce resources. Here, the focus is on small number of or group of units rather than all units combined, and therefore it does not explain what is happening in wider economic environment. We mainly study the following in microeconomics. First, product pricing. Second, consumer behavior. Third, factor pricing. Fourth, the economic condition of a section of people. Fifth, behavior of firms. And sixth, location of an industry. Macroeconomics is the study of overall economic phenomena or economy as a whole rather than its individual parts. Accordingly, in macroeconomics, we study the behavior of large economic aggregates such as the overall level of output, total consumption, total saving, and total investment, and also how these aggregates shift over time. It analyzes the overall economic environment in which the firm, government, and household make decisions. However, it should be kept in mind that economic environment represents the overall effect of innumerable decisions made by millions of different consumers and producers. A few areas that come under macroeconomics are: first, national income and national output; second, the general price level and interest rates; third, price third, balance of trade and balance of payments; fourth, external value of currency; fifth, the overall level of saving and investment; and sixth, the level of employment and rate of economic growth. While business economics is basically concerned with microeconomics, macroeconomic analysis also has got an important role to play. Macroeconomic analyzes the background of economic conditions in an economy, which will immensely influence the individual firm's performance as well as its decisions. Business firms need a thorough understanding of macroeconomic environment in which they have to function. For example, knowledge regarding conditions of inflation and interest rate will be useful for businesses, economists in framing suitable policies. Moreover, the long run trends in business world are determined by prevailing macroeconomic factors. Having understand the meaning of micro and macroeconomics, we shall examine the nature of business economics. Nature of business economics. The economic world is extremely complex as there are a lot of interdependence among the decision and activities of business entities. Economic theories are hypothetical and simple in character as they are based on economic models built on simplifying assumptions. Therefore, usually there is a gap between proposition of economic theory and happening in the real economic world in which the managers make decisions. Business economics enables application of economic logic and analytical tools to bridge the gap between theory and practice. The following points will describe the nature of business economics. Business economics is a science. Science is a systematized body of knowledge which establishes cause and effect relationship. Business economics integrates the tool of decision science such as mathematics, statistics, and econometrics and economic theory to arrive at appropriate strategies for achieving the goals of business enterprise. It follows scientific methods and empirical tests the validity of the results based on microeconomics. Business economics is largely based on microeconomics. A business manager is usually concerned with achievement of predetermined objectives of organization so as to ensure the long-term survival and profitable functions in the organization. Since business economics is concerned more with the decision-making problems of individual establishments, it relies heavily on techniques of microeconomics. Incorporates elements of macro analysis. A business unit does not operate in a vacuum. It is affected by the external environment of economy in which it operates, such as the general price level, income and employment levels in the economy, and government policies with respect to taxation, interest rates, exchange rates, industries, prices, distribution, wages, and regulations of monopolies. All these are components of macroeconomics. A business manager must be acquainted with these and other macroeconomic variables, present as well as future, which may influence his business environment. Business economics is an art as it involves practical application of rules and principles for attainment of such objectives. Use of theory of market and private enterprise. Business economics largely uses the theory of markets and private enterprise. It uses the theory of the firm and resources allocation in backdrop of a private enterprise economy. Pragmatic in approach. Microeconomics is absurd and purely theoretical and analyzes economic phenomena under unrealistic assumptions. In contrast, business economics is pragmatic in its approach as it tackles practical problems with the firm face in real world. Interdisciplinary in nature. Business economics is interdisciplinary in nature as it incorporates tools from other disciplines such as mathematics, operations research, management theory, accounting market, finance, statistics, and econometrics. Normative in nature. Economic theory has developed along two lines, positive and normative. A positive or pure science analyzes cause and effect relationship between variables in an objective and scientific manner, but it does not involve any value judgment. In other words, it states what is of the state of affairs and not what ought to be. In other words, it is descriptive in nature in the sense that it describes the economic behavior of individuals or societies without prescribing about the desirable or otherwise of such behavior. As against this, a normative science involves value judgment. It is prescriptive in nature and suggests what should be a particular course of action under given circumstances. Welfare considerations are embedded in normative science. Business economics is generally normative or prescriptive in nature. It suggests the application of economic principles with regard to policy formulation, business decision making, and future planning. However, if the firms are to establish valid decision rules, they must thoroughly understand the environment. This requires the study of positive or descriptive economic theory. Thus, business economics combines the essentials of normative and positive economic theory, the emphasis being more on the former than the latter. 1.3 Scope of Business Economics. The scope of business economics is quite wide. It covers most of practical problems a manager or a firm faces. There are two categories of business issues to which economic theories can directly be applied. Namely, first, microeconomics apply to operation or internal issues. Second, macroeconomics apply to environmental or external issues. Therefore, the scope of business economics may be discussed under the above two heads. First, microeconomics apply to operational or internal issues. Operational issues include all those issues that arise within the organization and fall within the purview and control of the management. These issues are internal in nature. Issues related to choice of business and its size, products decisions, technology and factor product combination, pricing and sales promotion, financing and management of investment and inventory are few examples of operational issues. The following microeconomic theory deals with most of these issues. Demand analysis and forecasting. Demand analysis pertains to the behavior of consumers in the market. It studies the nature of consumer preference and effect of changes in the determinants of demand such as price of a commodity, consumers' income, price of related commodities, consumer taste and preferences, etc. Demand forecasting is a technique of predicting future demand for goods and services on the basis of the past behavior of factors which affect demand. Accurate forecasting is essential for a firm to enable it to produce the required quantities at the right time and to arrange well in advance for the various factors of production. Raw materials, labors, machines, equipments, buildings, etc. Business economics provide the manager with the scientific tools which assist him in forecasting demand. Production and cost analysis. Production theory explains the relationship between input and output. A business economics has to decide on optimum size of output, given the objectives of the firm. He has to decide also to ensure that the firm is not incurring undue cost. Production analysis enables the firm to decide on the choice of appropriate technology and selection of its least cost input mix to achieve technical efficient way of producing output given the inputs. Cost analysis enables the firm to recognize the behavior of costs when variables such as output, time period, and size of plant change. The firm will be able to identify ways to maximize profits by producing the desired level of output at the minimum possible cost. Inventory management. Inventory management theories pretend to the rules that firms can use to minimize the cost associated with maintaining inventory in the form of work in progress, raw materials, and finished goods. Inventory policies affect the profitability of businesses, a firm. Business economics use methods such as ABC analysis, simple simulation exercises, and mathematical models to help the firm maintain optimum stock of inventories. Market structure and pricing policies. Analyze analysis of the structure of market pro- provides information about the nature and extent of competition which the firm have to face. This helps in determining the degree of market power, ability to determine prices, which the firm commands, and the strategies to be followed in market management under the given competitive conditions, such as product design and marketing. Price theory explains how prices are determined under different kinds of market conditions and assists the firm in framing suitable policies for price. Resource allocation. Business economics, with the help of advanced tools such as linear programming, enables the firm to arrive at best course of action for optimum utilization of available resources. Theory of capital and investment decisions. For maximizing its profits, the firm has to carefully evaluate its investment decisions and carry out a sensible policy of capital allocation. Theories related to capital and investment provide scientific criteria for choice of investment projects and an assessment of efficiency of capital. Business economics support decision making on allocation of scarce capital among competing uses of funds. Profit analysis. Profits are most often uncertain due to changing prices and market conditions. Profit theory guides the firm in measurement and management of profits under conditions of uncertainty. Profit analysis is also immensely useful in future profit planning. Risk and uncertainty analysis. Business firms generally operate under conditions of risk and uncertainty. Analysis of risk and uncertainties help the business firms in arriving at efficient decisions and in formulating plans on the basis of past data, current information, and future prediction. Second, macroeconomics applied to environmental or external uses. Environmental factors have significant influence upon the functioning and performance of businesses. The major macroeconomic factors relate to type of economic system, stage of business cycle, the general trends in national income, employment, prices, savings and investment, government's economic policies like industrial policy, competition policy, monetary and fiscal policy, price policy, foreign trade policy, and globalization policies. Working of financial sector and capital market, social economic organizations like trade unions, producers and consumers union and cooperatives, social and political environment. Business decisions cannot be taken without considering these present and future environmental factors. As the management of the firm has no control over these factors, it should fine tune its policies to minimize the adverse effects. Summary. First point. An economic exists because of two facts, that is, human wants are unlimited and their resources are scarce. Second, economics is the study of processes by which the relatively scarce resources are allocated to satisfy the competing unlimited wants of human beings in a society. Third, the subject matter of economics is divided in two parts, micro and macro. Fourth, microeconomics examine how the individual units, consumers, or firms make decisions as to how to efficiently allocate the scarce resources. Fifth, macroeconomics study the behavior of large economic aggregates, such as the overall level of output, total consumption, total saving, and total investment, and how these aggregates shift over time. Sixth, business economics integrate economic theory with business practice and relies on economic analysis in the formulation of business policies. Seventh, while business economics is basically concerned with microeconomics, macroeconomic analysis has got an important role to play. Macroeconomics analyzes the environment in which business has to function. Business economics is a normative science which is interdisciplinary and pragmatic in approach. There are two categories of business issues to which economic theories can be directly applied, namely microeconomics applied to operational or internal issues and macroeconomics applied to environmental or external issues. 10th, business economics makes us use of microeconomic analysis such as demand analysis and forecasting, production and cost analysis, inventory management, market structure and pricing policies, resource allocation, theory of capital and investment decisions, profit analysis, and risk and uncertainty analysis. Business 11th, business economics also concern macroeconomics related to economic system, business cycles, national income, employment, prices, savings and investment, government's economic policies and working of financial sector and capital market. Study of inventory management, product and promotion policy, resource allocation, capital budgeting, risk and uncertainty analysis are outside the scope of this book. They will be taught in other subjects, financial management, strategic management, etc. at higher level of CA course.